Welcome everyone to The Deep Dive. I'm really glad you're joining us today. We're going to be digging into something incredibly important, something vital for all of us, really, financial freedom. Here, we take a whole stack of sources, articles, research, all our notes, and we try to pull out those key nuggets of wisdom, give you a shortcut to being genuinely informed.
Yeah, cutting through the noise.
Exactly. And today, we're not just scratching the surface. We are diving deep into what makes some people financially resilient.
Yeah.
Truly unshakable no matter what the economy is doing.
And for this deep dive, our goal is laser focused. We want to distill that timeless financial wisdom, those really practical strategies from, well, a pretty foundational source.
Right.
The aim is to help you cut through all that noise you hear in the financial media, understand how markets actually work, which can be complex, let's be honest, and ultimately give you the tools, both mental and strategic, to build a genuinely unshakable financial future. And this isn't just about piling up cash. It's deeper. It's about achieving real confidence, genuine peace of mind, and finding a life with purpose.
Exactly. And the source we're digging into today, it's really a goldmine of actionable advice. It's Tony Robbins' Unshakable, the Financial Freedom Playbook.
A classic. Wow.
We're specifically pulling from a detailed chapter-by-chapter summary of the audiobook version. Now, it came out back in 2017.
Right.
But what's amazing is, even now, years later, June 2025, the advice feels incredibly relevant, timeless, really. Powerful strategies for stability and confidence.
Yeah, its relevance right now, with the economy feeling, unpredictable sometimes, maybe shifting fast, it just can't be overstated.
Totally.
Unshakable isn't about quick fixes or, chasing the latest hot trend. It's focused on building these really solid fundamental strategies that help you weather any economic storm, adapt smartly to market changes, and cultivate lasting wealth.
So building a framework.
Exactly, a resilient framework for your financial life, instead of just reacting, to every single headline.
Okay, so here's our mission for you, the listener, today. Over this deep dive, we're going to systematically unpack the core principles Robbins lays out. We'll start with the mindset piece, the psychology, then understand how markets really work beyond the surface noise. We'll look at this all-weather approach to investing, designed to work in any conditions.
Super important.
Then grasp that almost magical power of compounding, and crucially, how to dodge those common pitfalls, like those sneaky high fees that eat away at your wealth.
Oh yeah, the fee discussion is vital.
Definitely. We'll also touch on building a supportive financial dream team. And finally, kind of shift perspective to finding purpose beyond just making money.
Right.
And like we said, we're not just summarizing. We're unpacking the key ideas, looking at the historical context, and importantly, using compelling real-world examples, especially focusing on what's happening right now, as of June 19, 2025, to give you concrete, relevant takeaways.
And as we go through these ideas, I'd really encourage you, the listener, think about your own financial mindset. Where do you maybe react emotionally when the market dips? Where could you perhaps refine your own approach?
Good point.
Because these insights, they're not just theory, right? They're designed to be applied directly to your journey, your path towards real financial stability and freedom. So let's explore how these principles might resonate with you and empower you to act.
The Unshakable Foundation. Cultivating a resilient financial mindset.
All right, let's jump right in. Chapter 1, the Unshakable Foundation. This is arguably the bedrock of the whole playbook. Robbins says straight up, financial success isn't just about, spreadsheets and algorithms or picking the next big stock.
Right, it's not the typical starting point you might expect.
Exactly. He argues it's profoundly about your inner game, your psychology. Cultivating this deep sense of, inner calm. It feels counterintuitive, doesn't it? Most people, market drops, gut reaction is panic.
Total panic, yeah. Fight or flight kicks in.
So how does Robbins convince us that developing this inner calm isn't just a nice to have, but a strategic weapon, especially against our own hardwiring when facing potential financial loss?
That's really the core of it, and where it gets strategic, moving beyond just, think positive. Robbins brilliantly unpacks how our evolutionary biases, things like loss aversion.
Ah, yes, the pain of loss feeling stronger than the joy of gain.
Exactly. Twice as strong, typically. How these biases can hijack our financial decisions. When markets get choppy, our amygdala, the brain's threat detector, goes into overdrive.
Right, red alert.
Red alert. It triggers fight or flight, leading to impulsive stuff like panic selling at the worst possible time. which consistently just locks in losses and totally derails long-term plans.
Been there, seen that.
Right. So inner calm, as Robbins defines it, isn't about ignoring those real visceral feelings of fear or anxiety. It's about developing the discipline, the self-awareness to notice those feelings without automatically reacting to them.
Creating a space between feeling and action.
Precisely. A mental buffer zone. It allows you to stick to your rational, pre-planned strategy, stopping that primal panic from causing destructive financial behavior. It's like a strategic defense against our own human nature, keeping you anchored when the financial seas get rough.
That makes a lot of sense. Self-mastery against external chaos. And looking back, you mentioned the 2008 financial crisis. That certainly taught many the hard way about staying grounded. That was intense.
Oh, profoundly intense. The 2008 crisis was a stark, incredibly painful, but ultimately invaluable lesson in why a strong financial mindset is absolutely essential.
What triggered it again, in simple terms?
Well, it was a complex mess, really. Rampant subprime mortgage lending, these super complex, opaque financial products like CDOs.
Collateralized debt obligations, right?
Yeah, those. And a massive housing bubble that burst spectacularly. It wasn't just local, it went global. Major banks collapsed, huge job losses, a deep, long recession.
And the panic among investors.
It was palpable, almost contagious. We saw countless people just gripped by fear, overwhelming uncertainty, selling everything off right at the market bottom, locking in devastating losses, wiping out retirement savings.
Even if they had a decent plan beforehand.
Often, yes. They had sound, diversified portfolios, but the emotional reaction just completely overrode their rational strategy. In contrast, the people who stayed grounded, the ones who really got the cyclical nature of markets, had a clear, long-term plan and, crucially, had the emotional strength to stick with it.
They fared better.
Much better. They not only preserved their wealth, but often used the downturn as an opportunity, continuing to invest, rebalancing. They understood that the underlying value of good assets hadn't vanished, just the market perception in a crisis. Their mindset let them see past the immediate fear, keep that long view, and they recovered, even thrived, when the market eventually came back.
Which brings us to a really interesting modern twist. Proof this advice is timeless. I've heard about Indian investors, right now in 2025, using mindfulness apps during market dips to stay calm. How does that connect to Robbins' call for a solid mindset?
It's a fantastic, super relevant example. It perfectly shows how Robbins' principles apply in today's world, with today's tools. We are seeing this trend in 2025, where Indian investors are integrating mindfulness practices, often using apps like Headspace, Calm, or even local Indian platforms right into their financial routines.
So like meditating before checking their portfolio.
Exactly. Or maybe using guided breathing exercises, positive affirmations to cultivate mental clarity and emotional regulation. An investor might start their day with a short meditation focused on patience, long-term vision, setting an intention not to get swayed by daily market noise.
Okay.
Then when a market correction hits, like we saw some sector dips earlier in 2025, instead of instinctively checking their phone, seeing red, and panicking,
They take a breath.
they might do a quick, guided breathing exercise through the app, just a minute or two. That pause creates a vital psychological buffer. It stops that impulsive, fear-based sell decision.
And does the cultural context in India play a role?
Absolutely. India has deep roots in practices like yoga and meditation, so the concepts are often familiar and resonant. Extending mindfulness to financial well-being feels quite natural for many.
So the apps might even have financially themed content.
Some do, yeah. An app could send a push notification like, market volatility is temporary, my long-term plan is strong, or an affirmation, I make financial decisions calmly and rationally, aligned with my goals. It reinforces that steady, disciplined attitude Robbins champions.
Helping them detach from the emotional roller coaster.
Precisely. Keeping decisions rooted in logic and strategy, not knee-jerk fear. It's a proactive, modern way to build that inner calm.
The truth about the market understanding cycles and volatility.
That mindfulness example really hits home the power of mindset. But okay, mastering our internal state is step one. What about the external world? Because Robbins isn't suggesting markets will always be calm, right? In Chapter 2, he pulls back the curtain on how markets really work. He reveals their emotional, cyclical nature, trying to demystify them, show they aren't always these perfect rational machines.
He absolutely is, and it's a crucial demystification. Robbins hammers home that markets are driven profoundly by collective human emotion. Fear, greed, euphoria, despair. It's these feelings, often more than pure logic, that move prices, especially in the short term.
Which feels weird because we think of finance as being all about numbers.
Exactly. It's counterintuitive. But understand that volatility, those swings, isn't some weird aberration or surprise event, but a normal, inherent, even predictable characteristic of financial systems. That's the key takeaway.
So expect it. Prepare for it.
Precisely. Build your psychological and strategic framework, knowing these swings will happen, rather than being shocked or paralyzed when they do. He teaches you to see volatility almost like seasons natural recurring.
Okay, so what does this mean for us practically? Is it just accept the ups and downs, or is there a real strategic edge here? Can we thrive, not just survive?
Oh, it's definitely more than just passive acceptance. It's about a deep strategic understanding that leads to proactive moves. These market cycles, boom and bust, expansion and contraction, they aren't random. They're fundamental, recurring patterns.
Driven by.
A mix of things: macroeconomic factors, shifts in investor psychology, tech changes, even geopolitics. Now, understanding these cycles isn't about trying to perfectly time the market, predict the exact top or bottom. That's a fool's game.
Right.
Instead, it's about shifting your whole perspective. When there's a downturn, instead of fear, you start to see potential opportunity.
Buying low.
Exactly. Acquiring quality assets at a discount. Conversely, when things get really frothy, speculative, maybe that's a signal to prudently rebalance, trim some risk, take some profits.
So how do you prepare?
Strategic preparation involves things like robust diversification, which we'll get to, and keeping some cash aside, ready for those buying opportunities. That preparation mitigates the negative hit of downturns and lets you ride out the volatility with more confidence, maybe even capitalize on it, instead of getting swept away by emotion.
And history gives us stark reminders. Nothing screams power of market swings like the 1929 stock crash. That's legendary, almost mythical in its severity. What can that event still teach us today?
Oh, 1929, Black Tuesday. It's a monumental, enduring lesson in market irrationality and the sheer destructive force of collective panic. The severity was just staggering. The market lost nearly 90% of its value over about 3 years.
90%.
Unimaginable today. Its impact on the economy was catastrophic, a key trigger for the Great Depression. Widespread bank failures, mass unemployment, social upheaval.
And the psychological impact.
Deeply traumatic. It shattered public trust in markets for generations, created this pervasive sense of financial despair. Now look, today we have circuit breakers, much more regulation, better transparency, so a crash exactly like that is far less likely.
Okay, good.
But the core lesson, absolutely relevant: unchecked speculation, too much leverage, herd behavior driven by emotion, these can still amplify downturns with terrifying speed. It powerfully underlines Robbins' point. Understanding the market's emotional, cyclical nature is vital, even if the specific triggers change over time. It shows how fundamental value can get totally disconnected from market price when fear takes hold.
Right. Bringing it right up to today and super relevant for our listeners, particularly in India. In 2025, we saw Indian markets bounce back strongly after a notable correction in 2024. This feels like a real-time validation of that resilience and cyclical nature. Can you unpack that?
Yeah, this Indian market example is a fantastic illustration of Robbins' points in action. That 2024 correction likely meant a significant, though temporary, dip in key indices like the Nifty 50 or Sensex, maybe 10%, 15%, even 20% down from their peaks.
One might have cost it.
Could have been a mix of factors. Maybe global slowdowns hitting IT exports, rising interest rates, making growth stocks less attractive. Maybe some domestic issues like temporary inflation spikes or supply chain hiccups. It definitely would have tested investors' nerves, especially newer ones.
But then came the bounce back in 2025.
Exactly. The Nifty 50, for example, didn't just recover, it pushed to new record highs. This demonstrates the Indian market's fundamental ability to absorb shocks, correct itself, and resume its long-term upward trend.
What's driving that resilience?
It's underpinned by strong fundamentals. India's massive domestic consumption, the young, growing workforce, that demographic dividend, huge infrastructure spending, the booming digital economy. These are powerful long-term drivers.
And specific sectors led the recovery.
Yeah, we saw strength in areas like public sector enterprises, renewable energy, defense tech, also some manufacturing and financial services pockets. It shows how capital smartly reallocates to areas with strong growth prospects.
So the lesson is?
The lesson is clear. Short-term volatility, while definitely unsettling, shouldn't derail a sound, long-term investment strategy. It confirms that ups and downs are part of the game, and patience, combined with conviction in the underlying economy, consistently rewards those who stay invested. Corrections can even be opportunities, like Robbins suggests.
The all-weather portfolio building for any economic climate.
That's a perfect segue. Okay, we've got the inner game, the mindset. We understand the market's wild nature. But knowing isn't enough. How do you build something, a structure, that can actually withstand those storms?
Right.
That's where Chapter 3 comes in, with Robbins' concept of the all-weather portfolio. Designing a financial fortress, basically, that thrives in any economic weather, not just sunshine.
Exactly. The core idea of an all-weather portfolio is building this strategically diversified mix of assets. But it's not just randomly throwing different things together. It's meticulously designed so the whole portfolio can perform reasonably well across all kinds of economic environments.
Like high inflation, deflation.
Yeah, high inflation, deflation, strong growth, deep recession, the whole spectrum. It's a sophisticated way to reduce risk through smart, deliberate diversification. The goal is consistency, ensuring that if one part of your portfolio is struggling in, say, a recession.
Another part is likely doing okay or even well.
Precisely. It smooths out the ride, reduces overall volatility significantly.
Okay, so diversify smartly. What does that really mean? Because anyone can buy a few different stocks and call it diversification, right? What's the specific logic or genius behind the all-weather mix?
That's a great question because diversification gets thrown around a lot. Smart diversification, especially in the all-weather context, goes way deeper. It's about allocating capital across asset classes that have historically behaved differently or uncorrelatedly under various economic conditions.
Uncorrelated, okay.
Robbins, drawing a lot from Ray Dalio's principles, advocates for a balance, typically including stocks, long-term bonds, commodities, and gold. The logic is key. Each class tends to shine in different economic weather.
Right, so stocks for growth.
Stocks or equities, yeah, they're your growth engine. They thrive mostly when the economy's expanding, companies are profitable, potential for big gains.
And bonds.
Long-term bonds, especially government bonds, often act as the anchor, the safe haven. They tend to do well during contractions, deflation, or when interest rates fall. They provide stability when stocks are shaky.
Okay, makes sense. Commodities.
Things like oil, metals, agricultural products, these can offer crucial protection against inflation. Their prices often rise when the cost of living goes up, hedging against that loss of purchasing power.
And gold.
The classic.
The classic safe haven, exactly. Gold traditionally does well during high inflation, geopolitical turmoil, currency devaluations, or just plain old market fear. It's like the ultimate insurance policy in the portfolio.
So the percentages aren't fixed. It's the principle of balance.
The principle of balancing these non-correlated assets is paramount. A simplified example might look something like 30% global stocks, maybe 40% long-term government bonds, 15% commodities, 15% gold. But the exact percentages can vary. The core idea is that these different pieces work together to smooth returns, lower overall risk, and help you navigate any market climate, not just bet on endless growth. It's about robustness.
That breakdown really clarifies the why behind the mix, and history, again, provides context. The 1970s inflation era that really hammered home the need for this kind of variety, didn't it? Traditional portfolios got crushed.
Oh, absolutely crushed. The 70s were incredibly tough. We had stagflation, that toxic mix of high inflation, stagnant growth, high unemployment. Just awful for investors.
Well, traditional portfolios were often heavy on growth stocks and standard bonds. High inflation just eroded the real value of bond payments and stock returns. Stagnant growth meant company earnings weren't really going anywhere. If your portfolio was mostly large U.S. stocks and fixed-rate bonds, you were in a world of pain.
So what did work?
Assets that could handle inflation. Commodities, oil prices soared, gold did very well. Real estate often held its value or increased. It was a brutal lesson. A portfolio focused only on equity growth is incredibly vulnerable to different economic pressures. It powerfully showed the need for a diverse array of investments, beyond just stocks, to protect capital and purchasing power in different economic regimes. Diversification isn't just spreading risk, it's preparing for different economic possibilities.
Okay, fast forward to now, 2025, India. We're seeing investors actively mixing mutual funds and gold for stability. This sounds like a very practical, local application of that all-weather thinking tailored to the Indian context. How does this combo work?
It's an excellent real-world example of the strategy in action, adapted beautifully. Mutual funds are hugely popular in India, right? They offer easy access, professional management, diversification across stocks, bonds, hybrid options, all in one package. So an Indian investor might put a good chunk into diversified equity mutual funds to capture India's growth story.
Okay, that's the growth part. Where does gold fit in?
Gold holds this unique almost sacred status in Indian culture. It's more than just an investment. It's a traditional symbol of wealth, security, a hedge against bad times. And historically, it has been a reliable hedge against inflation, currency fluctuations, geopolitical risk.
And it often moves differently from stocks.
Critically, yes. Its value often moves inversely to equities during volatile periods. Stocks down, gold often up. That provides a crucial counterbalance.
So mutual funds for growth, gold for protection.
Exactly. By combining diversified mutual funds for broad market exposure and growth with gold for safety, inflation hedge, cultural store of value, Indian investors are intuitively building a robust, culturally relevant, all-weather type strategy. The funds capture the upside of the economy. The gold provides stability and a buffer against downturns, inflation, uncertainty. It's a pragmatic mix, diversifying across different risks and economic scenarios.
The power of compounding the long game of wealth building.
Right. On to Chapter 4. This is where Robbins talks about what Einstein supposedly called the eighth wonder of the world, compounding.
The magic of compounding.
He really pushes the idea of starting early, staying consistent. It's not about flashy wins, but about this quiet, relentless power of patience. Now, that sounds amazing, but patience feels, well, passive to some. In a world obsessed with instant results, viral successes, how does Robbins make the case that slow, steady compounding actually beats chasing those risky, quick-rich schemes?
That's a really important question in today's climate. Robbins tackles it head-on. He doesn't just say compounding is powerful. He shows why it's so profound, why it feels almost unnatural to our instant gratification brains.
How does he define it simply?
He breaks it down. It's not just earning returns on your initial money, it's those returns themselves generating more returns. It creates this exponential growth curve that's hard to intuitively grasp. Money you invest early has the longest time to grow, potentially dwarfing larger amounts invested later.
So how does he counter the get-rich-quick appeal?
He argues that chasing flashy, high-risk stuff is usually a losing game for most people. It's emotional, stressful, often leads to big losses. Compounding, conversely, is the consistent, reliable engine of sustainable wealth. It's a marathon, not a sprint. Its magic unfolds over decades.
So patience isn't passive.
Not at all. It's an active choice. A decision to trust the long-term growth of quality assets and the exponential power of reinvested earnings. It's letting time be your greatest ally, turning small, consistent efforts into massive wealth over decades. It helps you avoid those destructive temptations, market timing, speculative bets.
Okay, let's make it concrete. How do small, regular investments truly become big through compounding? It can sound almost too good to be true when you put small and big wealth together.
It does sound like magic, but it's just math plus time. Let's use a clear hypothetical example. Two people, same goal, different start times.
Okay.
Scenario A, Priya, the early bird. She starts investing 5,000 euro, about 60 US every single month, starts at age 25.
Okay, consistent.
Consistently for 40 years, till age 65. Let's assume a reasonable 8% average annual return pre-fees.
Possible with diversified equities long term.
Right. By 65, she's put in a total of 24 lakhs. That's 5K by 12 months by 40 years. But thanks to compounding her total, it's an astonishing over 1.5 crore, roughly $180,000 US, over 6 times what she put in.
Wow. Okay, scenario B.
Scenario B, Rohan, the late starter. Same euro, 5,000 a month. Same 8% return. But he starts just 10 years later at age 35. Invests for 30 years till 65.
Still a long time.
Still long, yes. He contributes 18 lakhs in total, 5K by 12 by 30 years, his final amount, around 65 lakhs, about $78,000 US.
Huge difference. He only started 10 years later and put in only 6 lakhs less.
Exactly. That dramatic difference highlights the two critical ingredients, time and consistency. Even small amounts invested regularly over long periods become substantial because your returns earn returns, creating that powerful upward curve. The earliest money worked the hardest for the longest. Time in the market beats timing the market.
And when you talk about decades-long consistent growth, the name Warren Buffett always comes up. He's like the ultimate real-world example, isn't he? The epitome of patience.
Absolutely. Buffett's journey is the living masterclass in compounding. Yes, he's a brilliant stock picker, understands businesses deeply, but the real secret to his immense wealth, two less glamorous things: unwavering long-term holding periods and decades of consistency.
They didn't get rich quick.
Not at all. Started investing small amounts as a kid, bought his first stock at 11. He's stayed invested for over 7 decades. Rarely sells. Just holds quality businesses forever, basically.
And his wealth grew exponentially later in life?
Hugely. Something like 99% of his net worth came after his 50th birthday. Why? Because compounding had more capital and more time to work its magic. He just let the snowball roll down a very, very long hill, picking up more snow.
So patience and consistency are more powerful than genius stock picks.
For building massive sustainable wealth over a lifetime, arguably, yes. His story proves that patience, consistency, belief, and long-term growth, these are far more reliable than trying to time the market or chase speculative bubbles. He has time in the market.
Okay, bringing it again to a current Indian example. 2025, young Indians are increasingly using SIPs, systematic investment plans, to harness compounding. This is super common, but it perfectly illustrates the principle. How do SIs work for them?
SIPs are ideal, yeah. Incredibly popular in India, especially for young people starting out. An SIP is simple. You invest a fixed amount of money regularly, usually monthly, into a chosen mutual fund.
Why are they so effective for young Indians?
Several reasons. One, consistency is built in. You automate it. Instead of a mandate with your bank, the money goes out automatically each month. No procrastination, no emotional timing attempts. Discipline without thinking about it.
Okay, that's powerful.
Two, rupee cost averaging. This is key. You invest a fixed amount, not a fixed number of units. So when the market's down, your 5,000 buys more units at a lower price. When it's up, it buys fewer units at a higher price. Over time, this averages out your purchase cost, reducing the risk of investing a lump sum at a peak.
Smart way to handle volatility.
Very smart. And three, accessibility. You can start small. SIPs often start at 500 or 1,000 over a month. You can increase it as your income grows.
So a young professional could start small and just let it run.
Exactly. Imagine someone in Mumbai just starting their career, sets up a 10,000 monthly SIP in a diversified equity fund, maybe for a house deposit in 15 years or retirement in 30. That consistent automated investment lets those small amounts benefit fully from compounding. Each payment builds on the last, plus the returns. It perfectly shows Robbins' advice. Build wealth through discipline and let time do the heavy lifting.
The role of fees protecting your returns.
That SIP example is really practical. Okay, now let's shift to something crucial, often missed, that Robbins hammers home: fees. Investment fees. He warns they're insidious, almost invisible, but can devastate your long-term wealth. Many people just don't grasp the impact until it's way too late.
Absolutely. This chapter's message is crystal clear and critical. Every single rupee, every dollar paid in fees is money that is not compounding for you. And over decades, those seemingly small percentages add up to a truly staggering amount of lost wealth.
So understanding fees, keeping costs low, it's paramount.
Paramount. Essential. Fees are the silent killer of returns, as Robbins puts it. They don't just reduce your gains in a given year, they shrink the base upon which all your future gains would have compounded. It's a double whammy.
Okay, so how do high fees eat into returns in a way that really matters? Can you illustrate the math again, make it tangible, maybe even a bit alarming?
Yeah, let's make it alarming, because it should be. The math is devastating over long periods because of compounding. Let's use that 10 lakh initial investment again, growing at 8% a year before fees.
Okay.
Scenario A, high fees. You invest in a fund or platform charging a 1.5% annual expense ratio. Pretty common for older, actively managed funds. Your net return is 8% minus 1.5% minus 1.5%. We go 6.5%.
Great.
After 30 years, that 10 lakhs, compounding at 6.5%, grows to roughly 86 lakhs.
Okay, still decent growth.
Seems okay in isolation.
Oh, sure.
Now, scenario B, low fees. You invest in a low-cost index fund or ETF charging just 0.1% annually. Your net return at 8% minus 0.1%, 7.9%.
Much closer to the full 8%.
Exactly. After the same 30 years, that 10 lakhs compounding at 7.9% grows to over 96 lakhs.
Wow. That's a 30 lakh difference just from a 1.4% fee difference.
A 30 lakh difference, around $36,000 USD, on your initial 10 lakh investment.
Yeah.
It's colossal. That's the corrosive power of fees eating away at your compounding engine year after year. Every rupee paid in fees is a rupee that never gets to grow exponentially for you.
So what kinds of fees should people look out for?
Robbins highlights several. Expense ratios, the annual fee charged by funds, ETFs, trading fees or commissions paid to brokers, advisory fees, often a percentage of your assets paid to an advisor.
And his advice is simple.
Unequivocal.
Yeah.
Seek out and prioritize low-cost options. Index funds, passively managed ETFs, they usually have minimal expense ratios. Be vigilant, demand transparency about all costs because they directly, substantially reduce your future wealth. They silently steal your financial freedom.
That example really drives it home. And historically, the 1990s were kind of notorious for high mutual fund fees hurting investors, often without them realizing the full damage, what was happening back then.
Yeah, the 90s investment scene was very different. Actively managed mutual funds were king. Everyone wanted the fund manager who could beat the market.
The star manager phenomenon.
Exactly. But these funds came with hefty price tags. Expense ratios of 1.5%, 2%, even 2.5% annually were common. Plus, you often had sales loads, commissions, just to buy or sell the fund shares.
So high costs for the promise about performance?
That was the promise. The problem: most active managers don't consistently beat their benchmark index over the long run, especially after you deduct their high fees. It's statistically very difficult.
So people paid more for less often.
Effectively, yes. Paying higher costs, taking on the risk associated with active management, but often ending up with lower net returns after those fees were taken out. Many investors just didn't realize how much those fees were compounding against them over decades. It perfectly validates Robbins' warning. Performance is only half the story. Costs are the other, equally critical half.
Which leads perfectly to today. 2025, Indian investors are actively switching to low-cost ETFs for better returns. This sounds like a direct response to that fee problem, a sign of growing awareness.
It's a massive positive trend in India, absolutely. And it directly reflects Robbins' advice finding traction. ETFs, exchange-traded funds, hold a basket of assets like mutual funds, but they trade on stock exchanges like individual stocks.
And the key difference is cost.
Often, yes, especially with passive ETFs. An ETF that just tracks an index, like the Nifty 50 or the Sensex, aims to replicate the index's performance, not beat it. Because there's less active management, the costs are typically way lower.
How low?
We're seeing expense ratios often below 0.5%, many even down around 0.1% or lower. Compare that to the 1.5% plus of older active funds. The long-term difference is huge, as we saw.
So investors are choosing lower fees over the hope of outperformance.
Increasingly, yes. They're realizing that capturing the market's average return reliably at a minimal cost often leads to better net results over time than paying a premium for active management that might underperform anyway. Why pay more to potentially get less?
Makes sense.
So a young India investor might choose a Nifty 50 ETF, get broad exposure to top companies for a tiny fee instead of paying a manager 1-2% to try and beat that index. It shows growing sophistication, keeping more of your money working for you, not for the fund company, protecting your capital's growth.
Creating your dream team, the power of expert guidance.
Okay, so we've covered mindset, market understanding, portfolio structure, compounding fees, a lot of individual actions. But in Chapter 6, Robbins shifts focus slightly. It's not just about you. He stresses building a dream team. You don't have to go it entirely alone, right?
Absolutely not. That's a core message here. Robbins argues powerfully that while your own effort and knowledge are vital, trying to navigate the immense complexity of finance completely solo is often inefficient, even risky.
So what is this dream team?
It's not just random contacts. It's a carefully chosen group of specialized professionals. Think financial advisors, skilled accountants, or tax pros, maybe even trusted mentors. The idea is that leveraging expert help can significantly speed up your wealth building, help you avoid costly mistakes, and navigate things you might not even know you don't know.
Recognizing your limits.
Exactly! Knowing where specialized knowledge isn't just helpful, but truly essential. Building a supportive ecosystem around your finances.
Okay, let's unpack that. How exactly do experts boost your success rather than just being another expense? Because let's be real, for many people, especially starting out, hiring professionals feels expensive. How do they provide value that outweighs the cost?
That's a fair and common concern, but it often misses the bigger picture, the potential return on that investment. Think of these experts as strategic leverage. Each plays a distinct role that often leads to greater net wealth or prevents significant losses.
Like a financial advisor, what do they really do beyond picking stocks?
A good advisor does way more. They help you build a comprehensive financial plan tailored to your specific goals, your risk tolerance, your life stage. They handle asset allocation, diversification smartly. Crucially, they can act as your behavioral coach during volatile markets, stopping you from making those emotional mistakes like panic selling.
The mindset coach again.
Yes. Plus, retirement planning, estate planning, strategy for big life events like buying property or funding kids' education. Their ability to keep you disciplined and optimize your strategy often generates value far beyond their fee just by preventing costly errors alone.
Okay, what about accountants? just for tax filing.
Not just filing. A savvy accountant or tax professional is vital for optimizing your tax strategy throughout the year. Finding legitimate deductions, credits you'd miss, ensuring compliance with complex tax laws. Their specialized knowledge can save you significant money every year by legally reducing your tax burden. That's more money to invest and compound. They also advise on tax implications of investment choices.
Minimizing future tax hits.
Right.
And mentors.
Mentors are often overlooked but incredibly powerful. They could be experienced investors, successful entrepreneurs, leaders in your field. They offer invaluable guidance based on their lived experience. They help you avoid common pitfalls they've already encountered, navigate career moves, spot opportunities, provide perspective, even emotional support. Their insights can save you huge amounts of time, money, and stress.
So the value comes from saved time, avoided mistakes, identified opportunities.
Exactly. The financial gains realized, or the losses avoided, often dramatically outweigh the fees. It's an investment in efficiency, specialized expertise, and ultimately faster progress and greater peace of mind.
And this idea isn't new. Looking back, the 1980s saw those famous business tycoons relying massively on advisors to build their empires. How did that era show this principle?
The 80s were a prime example. It was an era of huge economic change, massive corporate deals, M&A, leveraged buyouts, globalization kicking off, figures like Icahn, Pickens, maybe even a young Trump back then. They were doing monumental deals.
And they didn't do it alone.
Absolutely not. They depended on sophisticated networks of top-tier advisors. Elite lawyers for navigating complex contracts and hostile takeovers, aggressive investment bankers structuring billion-dollar deals, raising capital, specialized financial strategists who understood complex derivatives and tax angles, even PR experts to manage their public image during corporate battles.
So these advisors were integral partners.
Integral. They brought cutting-edge, specialized knowledge no single person could possess. They helped identify opportunities, manage colossal risks, execute deals that reshaped entire industries. It powerfully shows that leveraging specialized expertise has always been a key strategy for significant financial success at the highest levels. It was never a solo flight.
Which brings us today again. 2025, Indian startups are exploding, often fueled by strong mentor networks. Another contemporary example of the dream team in action, very relevant in India's dynamic economy.
Fantastic example, yes. India's startup ecosystem is booming, innovation, talent, digital adoption, but launching and scaling a startup is incredibly hard, high failure rate. That's where mentor networks become absolutely critical. They are the dream team for many founders.
Who makes up these networks?
Seasoned entrepreneurs who've done it before, industry veterans with deep domain knowledge, successful investors, functional experts. They offer much more than just advice.
Like what?
Strategic guidance on business models, market fit, crucial industry connections, introductions to investors, partners, early customers you couldn't reach otherwise, practical operational advice on everything from tech development to marketing to legal stuff, and vitally, emotional support. Being a founder is lonely and stressful. Mentors act as confidants.
Can you give a quick scenario?
Sure. Imagine a new edtech founder in Bengaluru struggling with user growth. A mentor, maybe from a successful Indian SaaS company, could connect them to investors, share effective digital marketing tactics for India, guide them on education regulations. Or a food tech startup in Delhi with logistics problems gets advice from a supply chain veteran mentor, helping them optimize delivery, cut costs.
Real tangible impact.
Absolutely. It validates Robin's point perfectly. External expertise, collaboration. It's not a luxury, it's a fundamental accelerator, turning potential into real growth, especially in a competitive space like Indian startups.
Just do it, enjoy it, and share it. The purpose of wealth.
Wow, we have covered so much ground. Mindset, markets, portfolios, compounding, fees, the dream team. And now we reach the final chapter, chapter 7. Just do it, enjoy it, and share it. This is where Robbins really zooms out, right? Moves beyond just getting wealth to its ultimate purpose. It's not just about the bank balance.
Exactly. This chapter is about the why. It elevates financial freedom beyond just numbers. It emphasizes that financial security, abundance, they aren't the end goal. They're a means to an end. A powerful, liberating means to a truly fulfilling, purposeful life.
And he breaks it down into 3 parts.
Yeah, a 3-pronged call to action. Take decisive action based on what you've learned. Find genuine joy and appreciation during the journey. And crucially, use your wealth intentionally to make a positive impact beyond yourself. It's about living a rich life in every sense, financially, experientially, contributionally.
So what does this mean practically for the listener? Wealth for living and sharing. Can you break down those three actions a bit more?
Sure, it's a really powerful framework.
First, just do it.
This is the foundation. All the knowledge from the book, from this deep dive mindset, diversification, low fees, whatever, it's useless unless you act on it. Don't get stuck in analysis paralysis. Don't wait for the perfect time. Start now. Set up that SIP, review your fees, talk to an advisor, make a budget, whatever the next step is for you. Take consistent, disciplined action. Freedom is built step by step, starting today.
Okay, action first, then enjoy it.
Yes, this is so important but often missed by really driven people. They defer all enjoyment until some distant future that might never come, or might look different when they get there. Robbins says, savor the journey now. Financial freedom should enhance your life along the way.
Ow.
Choose experiences, pursue passions, invest in your own growth, live fully in the present, don't just focus on accumulation. Make your money serve your life, not the other way around. Find that balance, appreciate the process.
Right, and finally, the big one, share it.
This, for Robbins, is the ultimate purpose, transforming wealth into a catalyst for real positive impact. He frames wealth not just as personal security, but as a powerful tool for good. Once your own foundation is secure, the deepest fulfillment often comes from using your resources to help others tackle bigger problems.
Through charity.
Charity, yes, but also supporting community projects, empowering education, helping those around you, whatever resonates. Using wealth for broader good provides a deeper, more lasting sense of purpose than just piling up more money ever could. It turns your individual success into ripples of positive change, living a life of significance, not just success.
And thinking about sharing wealth on a massive scale, the 2000s saw philanthropists like Bill Gates really change the game, didn't they? Setting new trends.
Monumentally. The 2000s marked a huge shift, largely led by Bill and Melinda Gates. When they set up their foundation, it wasn't just about the huge sums, it was the approach. They brought business discipline to philanthropy, focusing on complex global issues, disease eradication like polio, extreme poverty, education, sanitation.
With a strategic focus.
Highly strategic. Rigorous analysis, data-driven decisions, measurable outcomes, setting clear goals, tracking progress relentlessly, long-term commitment investing billions over decades, and partnerships working with governments, NGOs, other foundations to maximize impact.
So it wasn't just reactive giving.
Not at all. It was proactive, outcome-oriented. And this inspired wealthy individuals globally, including many in India, to think more strategically about their own giving. Not just donating, but investing for systemic change. It really redefined large-scale philanthropy, echoing Robbins' message about the purposeful power of sharing wealth.
And let's end with a really local, current example that brings the share it message right home. In 2025, we're seeing this inspiring trend of Indian millionaires donating significantly to local causes. How is this playing out?
It's a fantastic and growing trend, yes. As wealth grows in India, many high-net-worth individuals are focusing their philanthropy locally. Causes that resonate with their communities, their culture, their direct experience. It's not just big national charities, it's grassroots impact.
What kinds of local causes?
Hugely diverse. Funding school classrooms in villages, scholarships for underprivileged kids, digital learning centers, donating to local hospitals for equipment, funding mobile health clinics in underserved areas, supporting maternal health initiatives.
Environmental and community projects, too.
Definitely. Investing in local reforestation, water conservation in drought areas, community waste management programs, funding skill development for youth, women's empowerment through microfinance, supporting local artisans, building community centers.
Why the focus on local?
Often allows for more direct oversight, seeing the tangible impact. It addresses immediate, specific community needs, fosters a strong sense of local responsibility. It perfectly captures Robbins' final call. Using wealth to improve lives directly around you, creating interconnectedness, turning personal success into collective progress right where you live. That brings a unique kind of fulfillment. Outro.
Wow, what an incredible journey through Tony Robbins' Unshakable. We've really covered a huge amount of ground today.
We really have. It's such a comprehensive framework.
From building that core unshakable mindset to really understanding the truth about market cycles and volatility, then getting practical with the all-weather portfolio, harnessing that amazing power of compounding.
And crucially, understanding the drag of fees and how to minimize them.
Right, and the value of building your dream team of experts. And finally, landing on that ultimate purpose, not just making money, but truly living, enjoying, and sharing it.
It's been a fantastic exploration. And these aren't just abstract ideas, are they? They're practical, actionable steps anyone can take wherever they are on their financial journey to build stability, confidence, and a life with real purpose.
Yeah, the advice feels genuinely timeless.
It really is. Robbins provides such a powerful guide for navigating finance and truly taking ownership of your financial future, making it a tool for your dreams and contributions.
Okay, so here's a final thought for you, our listener, to chew on as you go, building on everything we've discussed from Unshakable. If that unshakable foundation is fundamentally about inner resilience, long-term vision, and disciplined action, not just money, what other areas of your life could massively benefit from applying those same principles? Strategic planning, smart diversification of your efforts, building your own supportive dream team. Where else could that apply?
That's a great question. And maybe pushing it one step further. How could that power of compounding apply beyond just investments? Think about compounding your learning, compounding the strength of your relationships, compounding your positive contributions to your community over time. Imagine that exponential growth, creating a truly unshakable life in the richest sense of the word.
Something to definitely think about. We really hope you explore these concepts further, maybe revisit your own strategy or look into some of those specific examples we talked about. Thank you so much for joining us on this deep dive into Unshakable.
Thanks, everyone.
Until next time.